Most Americans believe money works like this. You deposit your paycheck at the bank. The bank holds it. When someone needs a loan, the bank lends out a portion of what's been deposited. Your money sits there, safe, circulating through the economy in careful fractions. This is taught in schools, repeated in textbooks, assumed in households across the country. It is also completely wrong. The American banking system does not work this way. It never has. And understanding what actually happens, what has been happening since before your grandparents were born, changes everything about how you see the economy you live in. This isn't a story about corruption. It's a story about design. Money, in the modern American system, is not a physical thing that gets moved around. It's a number in a database, a ledger entry. When you check your bank balance on your phone, you're not looking at cash in a vault with your name on it. You're looking at a legal claim, a promise that the bank owes you that amount. The cash itself, the actual paper bills, represents less than 10% of all the money circulating in the U.S. economy. The rest exists only as data, as records of debt. And here's what matters. That digital money, the number in your account, wasn't created by the government. It wasn't printed by the Treasury. It was created by a bank. Most likely, it was created the moment someone, somewhere, signed a loan agreement. This is where the American system made its defining choice. When a bank approves a mortgage or a car loan or a business line of credit, it does not take money from depositors and hand it to the borrower. That's the story. That's the myth. What actually happens is this. The bank types the loan amount into the borrower's account. The money appears. It did not exist 1 second before. The bank does not check if it has that amount in reserves. It does not transfer it from some other account. It simply credits the borrower's account with new money and marks the loan as an asset on its own books. The borrower now has money to spend. The bank now has a contract saying that money plus interest will be paid back over time. Both sides of this transaction are real, but only one side existed before the agreement was signed. This is not a glitch. This is not a loophole. This is the system. In the United States, commercial banks, Bank of America, Wells Fargo, J.P. Morgan Chase, and thousands of smaller institutions create the majority of the money supply simply by issuing loans. They are not intermediaries. They are origin points. The Federal Reserve, established in 1913, does not create most of the money in America. It sets the rules, it controls the interest rates, it regulates how much leverage banks can use. But the actual expansion of the money supply, that happens in bank branches and loan offices every time credit is extended, and it is entirely legal. Some of you are watching this late at night, others are between jobs or between bills. Different lives, same system. The Federal Reserve's role is more subtle than most people realize. It doesn't print money in the way we imagine. It creates reserve balances, the money that banks use to settle transactions with each other. When the Fed wants to stimulate the economy, it doesn't hand out cash. It makes borrowing cheaper. It lowers interest rates. It buys assets from banks, expanding their reserves, giving them more room to lend. And when banks lend, money is born. During the Great Depression, this system collapsed inward. Banks failed, loans defaulted. The money that had been created through lending simply vanished as borrowers couldn't pay. The money supply contracted by nearly a third. It wasn't stolen, it wasn't hoarded. It disappeared because it had only ever existed as debt in the first place. The government responded with reforms, with deposit insurance, and with new regulatory frameworks. But it did not change the core mechanism. It stabilized the system so that money creation through lending could continue. Because by then, the American economy had become dependent on it. In 1971, President Nixon closed the gold window. The U.S. dollar, which had been loosely tethered to gold reserves, became purely fiat currency. Its value was no longer anchored to a physical commodity. It was anchored to trust in the American government and the performance of the U.S. economy. This was not a radical departure. It was an acknowledgement. The system had already been running on credit expansion for decades. Gold was a constraint that no longer fit the scale of economic activity the U.S. had built, so the constraint was removed. From this point on, debt wasn't a tool, it was a requirement. After World War II, America entered an era of unprecedented credit expansion. Mortgages became standard. Consumer credit became normal. The 30-year home loan, the car payment, the credit card. These became features of American middle-class life, and each one represented new money being created by banks and injected into the economy. This wasn't a conspiracy. It was policy. It was growth. The American standard of living rose in part because households could borrow against their futures. They could buy homes, cars, and appliances, not with saved money, but with credit. And every loan created new spending power that hadn't existed before. The economy grew, but so did the money supply, and so did the debt. If you've ever wondered why progress feels slower than effort in America, this is why. Inflation is not just about supply and demand. It's not just about oil prices or supply chain disruptions. It's structural. When banks create money through lending, that money enters the economy as purchasing power, more dollars chasing the same goods and services. Over time, prices adjust. They have to. The money supply has expanded and value dilutes. But inflation doesn't hit everyone equally. If you own assets, real estate, stocks, businesses, inflation can work in your favor. Asset prices rise with the money supply. Your home appreciates. Your portfolio grows. You borrow against your wealth at low interest rates and invest in more assets. The money created by the banking system flows toward you because you have collateral. You have access. If you rely on wages, inflation is a delayed tax. Your paycheck is negotiated in old dollars. By the time you receive it, the money supply has expanded. Rent goes up. Groceries cost more. Your raise doesn't keep pace because wages adjust more slowly than prices. You are always catching up. This isn't a moral judgment, it's a description of the mechanics. The system rewards leverage. It rewards access to credit. It rewards those who can borrow at scale and invest in appreciating assets. It does this not out of malice, but out of structure. The way money is created in America ensures that those closest to the point of creation, banks, corporations, real estate investors, wealthy individuals with high credit scores, benefit first and most. Everyone else receives the money later, after it has already begun to change the prices around them. In 2008, the American banking system nearly collapsed again. Loans that had been packaged, sold, and resold as safe investments turned out to be anything but. Housing prices fell. Borrowers defaulted. Banks found themselves holding assets that were worth far less than the loans they had created to purchase them. The government stepped in, not to punish, not to restructure, to stabilize. The Federal Reserve and the U.S. Treasury injected liquidity into the system, ensured the largest banks did not fail, and prevented another deflationary spiral like the 1930s. The rationale was clear. If the banks failed, the money supply would contract, loans would vanish, spending would collapse, depression would follow. So the system was saved, and the mechanism continued. After 2008, the Federal Reserve began a policy called quantitative easing. It purchased trillions of dollars in government bonds and mortgage-backed securities from banks, flooding the financial system with reserves. The goal was to encourage lending, to keep money creation flowing, and to prevent deflation. It worked. Credit markets stabilized. The stock market recovered. Housing prices rebounded. But the money created through these policies did not flow evenly. It flowed into financial markets, into real estate, into corporate buybacks. Wealth inequality in America widened, not because of cruelty, but because of where new money enters the economy and who has access to it first. As you're watching this, whether you're in the U.S. or somewhere else, consider this for a moment. When COVID-19 shut down the global economy in 2020, the Federal Reserve acted faster than it ever had before. It dropped interest rates to zero. It purchased assets at an unprecedented scale. It created more reserve money in a matter of months than it had in the previous decade. Banks, in turn, extended credit. The government issued stimulus checks, funded by borrowing that the Fed supported. Money flooded into the economy. People spent. Markets soared. And then, inevitably, inflation returned. Not just because of supply chains or pandemic disruptions, but because the money supply had expanded dramatically and the economy had not grown at the same pace. Too many dollars, same number of goods, prices adjusted. This is not a failure of the system. This is the system working exactly as designed. Money is created through debt. Debt drives growth. Growth requires more money, and more money over time means higher prices. The cycle does not end. It cannot end, because the modern American economy is built on the assumption that money will always be available to borrow, and that borrowing will always create growth. To stop the cycle would be to stop the economy. None of this is taught in American high schools. It's barely mentioned in college economics courses, unless you specialize. The mechanics of money creation are treated as technical, boring, and irrelevant to daily life. But they are the foundation of daily life. Every paycheck, every price tag, every rent payment, every asset valuation in America exists within a system where money is created by private institutions through lending, and where the government's role is not to create money directly, but to manage the rate at which banks can create it. This is not hidden. The Federal Reserve publishes data, economists write papers, central bankers give speeches, but the implications are rarely drawn out in plain language. The average American is not told the money in your account was probably created by a loan someone else took out. The purchasing power you feel slipping away is being diluted by the continuous creation of new money through debt. You are living inside a machine that requires constant expansion to function, and the cost of that expansion is borne unevenly. You don't have to agree with this. Just notice how familiar it sounds. There's a psychological weight to understanding this system, a kind of quiet dissonance. You work harder, save more carefully, plan further ahead, and still the goalposts move. Housing becomes less affordable. Retirement requires more savings. The middle class feels like a treadmill that speeds up the longer you're on it. This is not a personal failure. It is not a failure of character or discipline. It is the structural outcome of living in an economy where money is created through debt, where debt accumulates faster than income, and where inflation erodes purchasing power over time. American workers are extraordinarily productive. American households are extraordinarily resilient, but they are operating within a system that is not designed for them to get ahead easily. It is designed to grow, to expand, to create more credit, more debt, more money. And growth in this system does not mean prosperity for everyone. It means expansion of the money supply. And expansion of the money supply means those with access to credit and assets benefit first and most. This is not a moral claim. It is a description of incentives, mechanisms, and outcomes. So, where does this leave us? It leaves us with a choice that isn't really a choice. The system is not going to change, not because it's perfect, not because it's just, but because every alternative carries enormous risk. A return to the gold standard would constrain growth and likely trigger deflation. Eliminating fractional reserve banking would collapse credit markets. Preventing banks from creating money through lending would freeze the modern economy. The system exists because it works. Not for everyone, not equally, but it works in the sense that it sustains growth, prevents deflation, and allows the economy to function at a scale that would be impossible under older monetary systems. But understanding the system changes how you navigate it. If money is created through debt, then debt is not something to fear. It is something to use strategically if you have access to it. If inflation is structural, then holding cash is a slow loss. If asset prices rise with the money supply, then ownership becomes the only reliable path to wealth accumulation. These are not secrets. They are simply conclusions that follow from understanding the mechanics. The wealthiest people in America understand this instinctively. They borrow at low rates, they invest in assets, they use leverage, they position themselves at the point where new money enters the economy. They do not wait for wages to catch up with prices. They do not save in cash and hope it holds value. They understand the game, and they play it. The American banking system's ability to create money out of nothing is not a scandal. It is not a crime. It is a feature of modern monetary systems across the developed world. But in America, With its unique history, its cultural reverence for individualism and hard work, the gap between the story we tell and the system we live in is especially stark. We are taught that wealth comes from saving, from discipline, from effort. And those things matter. But they matter within a system where money itself is not scarce. It is constantly being created, and where access to that creation process determines who prospers and who struggles. This is the reality, not the myth. And once you see it, you cannot unsee it. The numbers in your bank account, the prices you pay, the debt you carry, the economic news you hear, all of it is downstream of this one fact. Money in America is created by banks when they make loans, and the system is designed to keep that process going, no matter what. It has been going on since 1913. It survived the Great Depression. It survived the end of gold. It survived 2008. It will survive the next crisis too, because the alternative is unthinkable, and so it continues, quietly, legally, inevitably. You were never taught this in school, but now you know. What you do with that knowledge is up to you.